world's local bank with a global secret. Warnings ignored, red flags dismissed. A river of illicit cash flowing unchecked. Billions laundered through his system. Drug cartels rob nations. How did it happen?
In December 2012, the U.S. Department of Justice announced that HSBC, one of the largest banks on earth, had laundered at least $881 million for Mexican and Colombian drug cartels, processed hundreds of millions more for countries under U.S. sanctions, and done so for years while internal warnings were ignored. The fine was $1.92 billion. Not a single executive was charged with a crime. The story of how that happened and what it revealed about the way power actually works in global finance is the subject of this video. To stay until the end, because the detail that closes this story is not the fine. It is what the bank did while it was supposed to be paying for what it had done. To understand how HSBC ended up processing cartel cash at its teller windows, the story has to start a few years earlier and several thousand miles south. In 2002, HSBC purchased Bital, the fifth largest bank in Mexico, as part of a broader strategy to grow into one of the largest financial institutions in the world. The deal came with a Cayman Islands banking license and a massive retail network across Mexico, exactly the kind of footprint a global bank wanted if it was trying to move money across borders at scale. What it also came with, and what HSBC's leadership either failed to notice or chose not to address, was a compliance operation that was nowhere near equipped to handle the volume or the risk of what was flowing through Mexican accounts. Between 2006 and 2010, HSBC Bank USA severely understaffed its anti-money laundering function. The systems designed to flag suspicious transactions were not capable of keeping up with the activity coming from the Mexican subsidiary, and the activity was not subtle. Drug traffickers from the Sinaloa cartel and other organizations were depositing hundreds of thousands of US dollars in bulk cash every single day into HSBC Mexico accounts. The sums were so large and the deposits so frequent that the cartels had custom-built boxes made designed to fit precisely through HSBC's teller windows so the cash could be passed across the counter without slowing down the line. A significant portion of the money then moved through the black market peso exchange, a system designed to convert US drug sale proceeds into clean currency for cartel operations in Colombia and elsewhere. This was not a rogue branch operating without oversight. It was a sustained, high-volume financial operation running through a major international bank for years, and warnings had been raised. The Senate subcommittee investigation that preceded the 2012 fine ran for more than a year and produced a 334-page report. What it found about the internal handling of warnings inside HSBC is as important as anything the bank admitted to in the settlement. As early as 2005, HSBC's chairman Stephen Green had been told by an employee that money laundering operations were taking place through the bank's Mexican network and that suspicious transactions had already occurred. That same year, a financial news organization publicly accused HSBC of laundering drug money. Green dismissed it, calling the accusation singular and wholly irresponsible. In 2008, 3 years after the first internal warnings, U.S. federal authorities directly informed Green that Mexican investigators had uncovered a money laundering operation involving HSBC in Mexico and an HSBC branch in the Cayman Islands. Authorities noted that such activity could carry criminal responsibility for the bank. HSBC promised to change its behavior. It did not. The deposits kept coming. The boxes kept fitting through the windows. A cease and desist order was finally issued against HSBC in October 2010. By then, according to the Department of Justice's own accounting, at least $881 million in cartel money had moved through the system. That figure covers only what investigators could trace and confirm. The total exposure was almost certainly higher. By the time the settlement was signed in December 2012, HSBC had also admitted to processing $660 million in transactions connected to countries under U.S. sanctions: Iran, Cuba, Sudan, Libya, and Burma, by deliberately stripping identifying information from payment messages before routing them through American financial institutions. The bank had also maintained correspondent banking relationships with institutions connected to terrorist financing. The fine was $1.92 billion. And then the question that stopped everyone who followed the case came to the surface. Nobody went to prison. Not the executives who received the warnings. Not the compliance officers who signed off on accounts. Not the managers who built and ran the system. A group of rank-and-file federal prosecutors had prepared a list of up to 175 criminal charges against the bank. That list was shelved. What made the absence of prosecution harder to accept for many investigators was what happened to the man who had been warned earliest and most directly: Stephen Green, the HSBC chairman who dismissed the 2005 money laundering accusations as wholly irresponsible, and who received the 2008 federal warning about criminal exposure. did not resign in disgrace. He was appointed a lord. He became the United Kingdom's Minister of State for Trade and Investment. He served in that government role from 2011 to 2013. During the same period, the Department of Justice was finalizing the settlement against the bank he had chaired. The Senate investigation also surfaced a separate thread that received far less public attention than the cartel money. HSBC had provided correspondent banking services to Al Rajhi Bank, a Saudi financial institution that investigators had connected to Al-Qaeda and violent extremist financing. Through its banknotes department, HSBC facilitated the physical delivery of US dollars to that institution. Those dollars, according to the Senate report, were used in terrorist financing. That finding sat inside the same 334-page document as the cartel deposits. It drew a fraction of the coverage. Instead, HSBC entered into a deferred prosecution agreement, a deal in which the bank admitted to the conduct, paid the fine, and agreed to 5 years of court-supervised monitoring. If it stayed compliant during those 5 years, the charges would be dropped entirely. The reasoning given for why no individuals faced prosecution came partly from a now famous statement by U.S. Attorney General Eric Holder, who said that when financial institutions become large enough, the prospect of prosecution creates concern about the impact on the national economy, perhaps even the world economy. That statement had a name before it was formally given one. The British government had already made the argument privately. George Osborne, then the UK's Chancellor of the Exchequer, wrote to us regulators warning that prosecuting Britain's largest bank could trigger global financial contagion and threaten economic stability. The message from both governments, delivered through official and unofficial channels, was the same. This institution is too large to charge. Senator Chuck Grassley put the consequence plainly. He said the Department of Justice had not prosecuted a single employee of HSBC, no executives, no directors, no compliance staff. He said that by allowing these individuals to walk away, the government was declaring that crime pays. He described the settlement as a get-out-of-jail-free card, purchased for $1.92 billion. To put that number in context, at the time the fine was handed out, $1.92 billion represented approximately 5 weeks of HSBC's profits. The bank absorbed it as a line item and moved on. What happened during the 5-year probationary period is where the story takes its final turn. A 16-month investigation by the International Consortium of Investigative Journalists and BuzzFeed News found that HSBC continued to provide banking services to alleged criminals, Ponzi schemers, shell companies connected to looted government funds, and financial intermediaries for drug traffickers while under court-supervised monitoring. The bank was not merely failing to improve, it was actively generating new suspicious activity reports filed by its own staff while simultaneously maintaining the accounts that generated them. More than a dozen former compliance officers who worked at HSBC during the probationary period gave interviews describing a function that had no real power. They said they were not given enough time to investigate suspicious transactions properly. They said branches outside the United States routinely ignored requests for customer information needed to complete due diligence. If that kind of deep dive is worth your time, hit the like button. It takes 2 seconds and makes a real difference to the channel. To subscribe so the next one lands directly in the feed, and share this with someone who thinks the financial system always plays by its own rules. See you in the next one.